Finding a financial advisor is hard. And once you do land on someone, you have to somehow figure out whether the advisor is good, which is pretty important given how much influence this person has on your ability to retire, pay for your kids' education, or even maybe buy a home. So I'm going to give you a checklist today that you can use to decide whether to hire or fire your financial advisor. This could be your current advisor or someone you're considering working with. This criteria is drawn from this book, It's Really Not Rocket Science, which you can get for free. And I'm going to make it really simple to get by pinning the link in the comments section. That's it. That's simple. So the first thing you need to know is the fees. Asking just for fees isn't good enough either. You need to know the all-in fee in percentage and dollar terms. The all-in part of that comment is crucial because different countries have different disclosure requirements. For example, here in Canada, advisors have to disclose the fees they charge for advice, but they're not required to disclose the fees for the investment products they put you in. On top of that, there may also be fees for administering your portfolio, things like custody costs, account setup fees, transfer fees, and so on. There's also sales tax, and these costs all add up. I often see situations where people tell me that their advisor charges them 1% of assets, but when we add everything up, the all-in fee is double that. And knowing your fee is, of course, important because it's really the only thing you know with certainty about your portfolio. You don't know how much your portfolio will grow over time, but you know how much you're going to have to pay in fees. And that ultimately eats at the returns your portfolio generates. Knowing the fees by itself doesn't tell you much though. So you should ask the advisor to clearly tell you what services those fees include. Because you might find that you're paying for more than what you need. Some advisors charge higher fees because they deal with complex situations like trusts or corporations, while your situation might be quite simple. Next up, incentives. Knowing how the advisor is incentivized tells you how aligned they are with you. And to uncover this, ask the advisor to show you how they invest their own money. And some people I know find this awkward, but you shouldn't feel like that. You're putting your financial future in this person's hands. In fact, this is a required disclosure in some cases. In the US, managers of funds must disclose how much of their own money is invested in the funds that they manage. This way investors know if they believe in the strategy or not. So you shouldn't feel weird asking an advisor for this same information. Now, of course, your situation is unique. There are different objectives and tolerances for risk. So you should expect some variances in the portfolio the advisor proposes for you. But there should also be a fair bit of overlap, and the advisor should be able to explain very clearly why those variances exist. Also ask how the advisor gets paid. Do they get a percentage of the assets they manage? Do they get commissions or bonuses for putting their clients in certain products? Because ultimately, incentives drive behavior. If your advisor gets fat commissions for selling insurance products, then they might push those products onto you, even if they're not right for your situation. Next up, returns. Investment returns are ultimately what will help you meet your goals. There are 3 P's underlying this: philosophy, process, and performance. The investment philosophy is the advisor's underlying beliefs about what they think the market is and what they think their strengths are. And advisors are rarely good at everything. There are advisors that focus on high-risk investments like small, less discovered companies. Others might prioritize income or dividend-producing portfolios. Now, once you have that philosophy, you want to know the process that they use to implement it. Do they use funds or do they use individual stocks or bonds? And one isn't better than the other. But if they do use funds, how do they go about figuring out which funds are best? And if they buy individual stocks and bonds, what kind of research are they doing on those investments? This philosophy and process needs to produce good portfolio performance, specifically long-term performance, at least 5 years and hopefully 10 or more, because it's about growing your assets over time. Last but not least, we come to the final part of the checklist, which is experience. Here, we're looking at what the advisor's background might be, where they've previously worked. Do they have any accreditations? Do they have any reviews on Google, Reddit, or elsewhere? And you should also look up the advisor to see what their status is with the regulators and if they've ever been sanctioned. The regulators make this information public. And you want to know the same about not just that advisor, but their teammates who they work with. Now, personally, what I emphasize when I'm looking at experience is a concept called accumulated regret. I want someone with some battle scars, someone who's survived bear markets, periods of poor performance, and just different market conditions. Now that you have this checklist, ask a few advisors to provide you this information so that you can compare responses. If you have an existing advisor, ask her or him to share these details too. Just like with any important decision, and this is an important decision, take your time and consider who aligns with your needs. I suggest keeping a scorecard. Rate a response to each of these points on a scale of 3, 1 being okay, 2 being good, and 3 is outstanding, and then tally up the points to see if someone really stands out. But if your advisor is unable or unwilling to address even one of the items on this checklist, fees, incentives, returns, and experience, fire them, because good advisors will always be transparent. So if you haven't done so already, make sure you get that free copy of It's Really Not Rocket Science by hitting the link in the comment section. It's full of practical steps that you can take to improve your financial future. Happy investing.